Hello everyone, welcome back to my channel. My name is Gabby. If you are not already familiar with me, and I love to talk all things personal finance, today's video is going to be exactly that. We're going to be talking everything to do with investing. I've had a lot of you guys reach out to me and ask how to invest, how to get started as a beginner, just for more information in general on investing, because it can definitely feel overwhelming and I completely understand. Maybe you've heard of terms like stocks and bonds, risk tolerance, or bull market. These are all common words in the financial space and they can definitely feel overwhelming. It can make us feel like, oh, that is way too complicated for me. That's for the finance bros. And it's definitely not. These are all easy to understand terms. And I think one of the best things that I've ever done for myself has just been improving my financial literacy. It goes a long way when you can actually understand what a loan is, what the risks are. I think that with the internet at our fingertips, there really is no excuse anymore to not invest or to not understand investing. That is my goal here today, is I'm hoping to make investing as clear and as simple as humanly possible so that you can get started on your investing journey. And if you are a seasoned investor, I hope that at least something today maybe resonates with you, or you learn a tip that you want to take with you on your investing journey as well. If you have great investing tips or anything you'd like to share as well, please leave it in the description box down below. I love this community for the fact that we can share our experiences and our knowledge. The decisions we make today have a huge impact on our financial future, and time is one of the most powerful things in investing. So I will talk about that a little bit more, but I just want you to know that if you are starting your investing journey, the best time for you to start is today. Even if that is a $1, $5, $10 investment, we will never get time back. Before I dive in, I definitely want to mention I am not a financial advisor. Please just take this as general advice, general tips. This video is just sharing what I've learned so far on this journey. Also, always do your own research, especially before investing your own money. And if you're able to, if you can financially afford it, definitely talk to a financial advisor about any financial decisions you want to make. Okay, so the first most important thing we have to discuss is why you should invest. Without having a good why, you're not gonna wanna put a bunch of your money away for 30 to 40 years. We have to have a really strong why. Investing is one of the easiest ways to make sure that your money, your saved money, doesn't lose value over time due to inflation. Inflation, I'm sure we've all heard of it, that thing that happens over time where the value of our money goes down as the cost or the value of items grows over time. You used to be able to use $3 to buy one carton of eggs. A couple years later, you need $9 to buy that same carton of eggs. So if you put all of your savings under your mattress, you're actually losing buying power with that money by not putting it into some sort of investment. There are a few ways to increase the value of your money, and investing is also one of the most accessible. For example, another method would be to buy a home, buy property, something that will increase in value over time. But investing is something that we can all do as long as you have access to the internet, a bank, you have a social security number, that kind of thing. If you were to leave some money sitting in a savings account, so a lot of people do this, instead of putting money under a mattress, they'll put it into a savings account with like a 1 or 2% interest rate. You will get some returns in that account, but it will be significantly lower than you will receive with investing. These accounts also have higher tax rates. So even when we are using like a high yield savings account, for example, let's say, I think a couple years back, my high yield savings account was getting me 5% interest. I was still not receiving 5% because I actually had to pay a good chunk of that back in taxes every year. A third reason why you should invest is that investing gives your money the chance to compound over time. So not only are you getting returns in the market, which is allowing you to compete with inflation, you should actually be getting compounded returns. So the longer your money is in the market, your returns in the market will make you more money because that money is used to repurchase more of whatever investment you are buying. And then by having more value of that investment, you can also receive more returns, and that continues to happen every year. And if anyone's ever seen one of those compound interest charts, I'll put one on the screen right now. The first 10 years, maybe you're not going to see these dramatic returns, but as your value of money invested grows, and as the time that has passed grows, you will see this exponential growth in your money. And this is usually what people do for retirement. A lot of people cannot rely on Social Security or, here in Canada, like a pension. You would need to have a nest egg of money invested as some form of retirement. A lot of work programs will do this for you, but for those of us who do not have retirement plans at work, aka me, it's important that we are investing in the stock market so that we can have this future. And then let's quickly talk about some common misconceptions about investing. I think investing has a bad rap for a lot of people, especially with women. I think that we can see it as a form of gambling. So let's quickly go over all of the misconceptions. The first misconception I hear a lot is that you need to have a certain amount of money to begin investing. I think people think you need to have like $500 to start, $1,000 to start, and that is simply not true. There are so many banking apps these days in whatever country you're in that will allow you to start investing with even as little as a few cents up to $1. There is this new thing called fractional shares where you can actually split one share of a company into whatever small of a piece that you want and you can buy it. There's no need anymore to save up $400 to buy Apple on the stock market. If I have $5 right now, I could technically buy $5 of Apple using a fractional share. A second misconception that I hear a lot is people wanting to time the market, or we have to wait until the market's down or that there's a good buying opportunity, and I would say that's generally an awful way to approach investing. One of the best things you can do with investing is just to continuously buy the market. So you are continuously buying when the market's up, when the market's down, whatever it's doing. Basically, don't even look at what the market is doing. Just continuously keep buying, and over time, you are almost guaranteed to max out your returns versus trying to find the very bottom of any sort of stock right before it shoots back up. That is very, very hard to do, and even some of the best investors in the world can't do it. So it's much better to just average out, generally invest, pick some sort of rate that you're going to invest in, whether that's every paycheck, every week, every month, whatever works for you. Just continue at it and keep doing it regardless of what the market's doing. And then, as I mentioned, I want to tackle the thought that investing is gambling. The difference between gambling and investing is that gambling is more of a short-term situation. You are putting a lot of money on a bet. You're going all in on the chance that something might happen, where investing is a lot more calculated. It is based in strategy, patience, and data. We know exactly what the markets typically do. We have a lot of data showing that markets grow over time. Sure, there are going to be periods it drags out. It might go sideways for a while. It might go down for a little bit. World events, COVID, of course, they impact the markets for long term. But if you look at general markets over a longer period, 30 years, it's going to be up compared to when you invested your money initially. So you're almost guaranteed returns as long as you're investing smartly and you're investing in things that are diversified and you're making sure you're not putting all your money in on, I don't know, what is something that's probably gone to zero? Weed stocks. That was one of mine, weed stocks. Next, let's talk about how I personally invest. So I use a platform called wealthsimple here in Canada. If you are a Canadian, I highly recommend using wealthsimple. I am going to show you guys the interface on my phone once we get going, but I am such a huge fan. I started using wealthsimple in, 2018 it must have been, as soon as I started my job, and I have absolutely loved it every single step of the way. I started by just putting my own savings and investments that I had into the wealthsimple platform. I had previous investments from an inheritance when my grandma passed away in the TD banking system, and over the years I have slowly just transferred everything over. They are so great with zero commission trading, so you do not have to pay a fee every single time you buy or sell any sort of stocks. With other major typical banks, you actually typically do, and it can be as high as $10 every single time you buy and sell, which is crazy if you are continuously investing, especially if you are diversifying and you're buying lots of different types of stocks and ETFs. That can get expensive. So please don't pay any sort of commission fees. Quickly look up if the bank you were hoping to invest with has commission fees. If they do, try to find another bank. You can move your money, transfer your money. It's not difficult. So don't be too fussed that maybe you're currently banking with this bank. Just try to find a bank that doesn't have commission fees. It's not worth it. There's so many banks that don't. Secondly, I love wealthsimple as well because they allow me to do automatic transfers, automatic investments, automatic savings. I can basically automate automate any single thing that I would typically do. When I would do it manually, I can automate. And this is one of my biggest personal finance tips. Automating my savings and automating my investments has been the #1 game changer for me, making sure that I'm constantly and continuously keeping to my goals, because it's just done. It's happening in the background. I don't have to think about it. I don't have to make any sort of decisions. I don't have to use any sort of mental load to make sure I'm investing or what should I buy or anything like that. I just set it, I forget it. And I think that's Wealthsimple's motto, like something set it or forget it, something like that. I will leave a referral sign up link in the description box down below. I believe you get money and then I also get money if you use that link. You need to be a new user with Wealthsimple. But I think of all of the Canadian banks, it's one of the best ones. They have the lowest fees and rates and all that. And I love the interface as well. I think that's another perk for me, is just the interface is clean, sleek, easy to use. They always have great perks. If you do have investments with another bank and you're gonna transfer them over to Wealthsimple, they have great perks like free iPhones, free MacBooks, things like that. I got my phone for free from Wealthsimple for transferring over some investment. Just a tip. I should also mention that Wealthsimple right now is running a deal where they will match 2% of the total value that you transfer over in a margin account, and they will match 1% for any other type of account. There is a minimum of $25,000, but if you have a good chunk of money sitting with another bank and you're willing to transfer it over to Wealthsimple, you do get a good kickback for doing so. If you are a completely new beginner, you need to find some sort of banking system, investment platform. You will need to sign up for an investment account with your country. In Canada here, you just need to sign up and then decide what investing account you're going to use. So I think you would enter all of your information, you know, address, name, age, income every year, things like that. And then you would go make an account. And then once you have an account made, you have to decide what investing accounts you want to open. So this is going to completely depend on your country, but here in Canada, we have access to the RRSP, the tfsa, and there's some additional accounts depending on your situation, like the fhsa, which is the first home savings account. You must be a first-time home buyer for this account. And then of course you have your crypto accounts, and then you have your non-reg accounts, which is just like a regular investing account. The difference between all of these accounts is the way that they're taxed. An RRSP and a TFSA are both tax advantaged accounts, same with the FHSA. So these are all tax advantaged accounts, meaning that you have some sort of tax benefit from using these accounts. All of these accounts will have a max amount that you can invest every single year. And typically as you age, you have more and more opportunity to invest more into these accounts. Look at the specific accounts for your country, look up tax advantaged accounts in your country, get a general understanding of what they are. Usually there's always a type of advantaged account which will have zero tax on your gains. So any money you make in this account is not taxed. So you know how you're taxed on your salary? These accounts allow you to not pay any tax on your gains. So these are incredible accounts. They are definitely the accounts I would recommend maxing out first. And then you have your tax deferred accounts. So these accounts typically allow you to defer tax until you are older and typically have a lower income. The hope is that you are paying more tax now and you would pay less tax later. So you're basically moving that tax to the future. So what it does for the here and now is it lowers your taxable income this year by the amount that you invest, and therefore you're gonna pay less tax this year. I hope that makes sense. You're gonna open your account, you're gonna set up your different tax advantaged accounts. I would highly recommend always using the tax advantage accounts until they're maxed out, and then move over to like a typical non-reg investing account. Let's just start the screen recording on my phone here, and I will show you guys what the Wealthsimple app looks like to me. They have this new amazing feature where I can hide the amounts in my accounts, which is great for something like this, where I'm just trying to show you the general structure of the app. So you can see here, this is all of my financial accounts. So I also bank with Wealthsimple. I use them as my checking account. I use it as my high yield savings account, and you're able to actually create as many savings accounts or buckets as you want as well. So if you are a sinking fund person, I highly recommend them for this reason as well. So let's go to the RRSP, for example. So this is my retirement account here in Canada, and this is a tax deferred account. So let's say I set up this account and I want to start purchasing in this account. So what you need to do first, you need to deposit some sort of money, and then you can buy stocks or ETFs in that account. Editing Gabby here, I wanted to re-record the voiceover for this section because I was not extremely clear when I was doing it the first time. I am currently in my retirement account, and you can see here that I have Canadian cash, about $857. And the first thing you will need to do before you can purchase any stocks or ETFs is you will need to fund the account. And funding the account alone is not investing. That's an important tip. I think a lot of people assume as soon as you deposit money into these accounts, you're going to get the benefits of compound interest, and that is not the case. You need to actually purchase investments in the form of either stocks, ETFs, or using a robo-advisor. If you deposit money as a robo-advisor, it will automatically get invested for you. But in a typical account where you are the investor, you will need to be purchasing stocks and ETFs yourself. Let's just assume I'm going to put in an order right now for a ETF. So I can either scroll down to my current holdings and select one of these to purchase, or I can go to trade up at the top here, and then I can look up the ticker. I want to buy FBAL, which is a Fidelity ETF product, and I can click into that. You will see the current share price as of the markets closing on Friday. The markets do not open until Monday morning. I can go to buy right here, and sometimes you will be sent to either one of these other options, like a limit purchase, for example, is common when the markets are closed. This basically allows you to set a limit price, which is the upper limit you are willing to pay for that ETF and stock, because the markets are currently closed and the value of this share could go up considerably on Monday morning. So you can set a price that you're willing to spend. It will only go through once the share value actually drops below this number. I typically just recommend sticking to the market purchases, and I will either just buy a certain number of shares or a dollar value. So I can either enter 4 shares, for example, right now. So that would be about 56 Canadian, or I can enter the Canadian dollar amount I want to buy. So let's just say I want to buy $100 worth, and then I can go to review here, and that is about 7.13 shares is the total value estimated at the time of the markets closing on Friday, but it might go down or up depending on the value of it on Monday morning. So I'm just going to queue this order right now, and there we go. I've purchased FBAL $100 worth, and that will go through as soon as the markets open on Monday morning. I will quickly walk you through the automations here in Wealthsimple. This is one of my favorite parts about it. So you can do recurring transfers. You can automate your pay. So this will actually specifically use your paycheck that you get paid. And you can see here, these are all of my automations. Every single time I get paid, $400 goes to the FIN ETF, $300 goes to my savings account, $250 goes into FCGS, $250 goes into FCUV, $100 goes into my savings account again, and then I have $100 that goes into FIN again, and then I have $100 that goes into Bitcoin, the Fidelity Bitcoin ticker. So this is just a little behind the curtain look at my investments and my automations. You can also just do automated deposits into an investment account, and then you can individually decide how much of each stock and ETF you want to do. I recommend just fully automating the whole thing. I sit down with my financial advisor every couple of months. We decide what I'm going to buy. Every couple of months, I set up my automations, and then I forget about it. It's my favorite thing ever. So let's talk about stocks and ETFs and index funds. A stock is basically a share of a company, and that portion of that company will have a value based off of what the company is worth today or how well they're doing today. The hope is over time, as the economy grows, as inflation works, as the company grows in size, the hope is that that company and that share of that company will go up in value over time. But you just don't know. Of course, companies fail all the time, businesses fail all the time. We just can't know what change in technology or whatever is going to happen that could completely deteriorate a really good company. That is why people say you should diversify. And you can either do that by buying a bunch of different companies on your own. So you could literally buy, maybe 30 stocks on your own every single time you get paid. Or what you can do is invest in ETFs or index funds. ETFs or index funds are baskets or bundles of a bunch of different stocks, and different banks, companies, investment firms will have their own ETFs or index funds that either follow an index market or they will be managed by a portfolio manager. An index fund basically follows an index. So for example, the S&P 500 is an index fund. It is basically just taking the top 500 companies in the US, and you would buy a portion of each one of those. And then every single time you buy, it reevaluates the top 500. That is one of the best metrics for the overall stock market economy. It's just how are the top 500 companies doing? Because typically in America, these top 500 companies kind of dominate the market in general. You can also find ETFs that are focused on different portions of the market. So you might want to buy a growth ETF, a growth stock ETF. So this would focus on growth stocks. You can buy a more balanced ETF. So this would be a very balanced product. It might have equal equity to fixed. The ratio between equity and fixed markets would be the same. Is that correct? I feel like I'm saying it wrong, but okay. Anyway, you might also buy like a commodities ETF, which would follow things like oil and gas, things like that. Also, ETFs can be global ETFs. They can be specific to a country. There's so many out there. I would either talk to a financial advisor or do your own research, maybe listen to some professionals in the field talk on this sort of thing. That is how I've learned a lot of what I know about investing, is just listening to people who know a lot more about it than I do. I hope walking through how I would invest with Wealthsimple was helpful, but of course, every single country has so many different banks, so you don't need to invest in this specific platform. Just find a platform that works. Make sure you're not getting charged on buying and selling. Look into the fees that they charge. A lot of banks have different fee structures, so something to look into as well. So the next question that a lot of people have is, how do I know what to invest in? And so as I covered, there are stocks, ETFs, index funds, all of these. There's millions of them out there. There's so many. So how do you know which ones to pick? And this is definitely one of those scenarios where there's no one size fits all. We're all gonna have a completely different way of approaching this. There's so many different ways to go about it, and it all just depends on what's important to you. But the number one thing I would say for beginners is don't dive straight into stocks and portions of companies. I would say definitely stick towards the ETFs and index funds, and just do some research on maybe like one or two that you should be buying every single paycheck that kind of cover all your bases. Maybe like a global one, and then maybe like an S&P, something like that. I think that is a great place to start at. I can't give you specifics on exactly what to buy with your money. I can't say buy this stock, this ETF, even the ones I just showed on screen. Those are for my goals. It's my risk tolerance. There's so many factors that go into the ones that I've currently decided to buy. I should also mention the robo-advisor option within Wealthsimple. This is called their managed accounts, and it is exactly what it sounds like. They will manage your money for you. It is a much cheaper option than going through a financial advisor. You basically fill out a questionnaire, and they will use that information from the questionnaire to determine your risk tolerance and exactly what you should be investing in based on your goals. They will then take all of the money that you deposit and they will invest it for you. I think this is such a good option for beginners, and it's actually the way that I got started investing in Wealthsimple as well. There are slightly higher fees with a robo-advisor than with buying your own stocks and ETFs, but it is such a good option for beginners, and you can always move towards buying your own stuff later on once you're more comfortable with investing. I think a great thing to also think about is, what is your risk tolerance? How quickly do you need this money? If you're hoping to save up a down payment in the next 1 to 2 years and you're hoping to make some gains in the market, I would definitely not go with like a growth ETFs, because the market is so volatile, and you definitely want to put your money in something that's a lot more stable and balanced. When the market goes down and crashes, that it doesn't really see as low of dips. Even the S&P is great in general, but you are going to see big losses on the years where the market is down, or if we have some sort of a recession. If you are investing for your retirement, the best part about that is that you can take on a lot more risk, because as I mentioned, over the course of 30 years, you're almost guaranteed to be up. So you can take a lot more risk. Definitely think about your time horizons, when you need the money, and definitely get some expert advice if you are able to. So at the end of the day, I think the number one thing I just want to drill into your heads is that the best thing you can do is start today. There is no such thing as too small of an amount to get started, and stop getting in your own way saying that you don't know how. There are so many resources online, and I just recommend opening an account, funding it. If you don't like the platform, you can switch it later. Transferring between accounts is super easy. So don't get all hung up on what account to use, what investment to buy. You know what? You can always change everything later. I invest today very differently than I used to 6 years ago. 6 years ago, I was buying random stocks, random companies, and I can say firmly that I have completely changed my investing strategy since then, and it's been super easy to go about that. I either hold on to the stocks that I used to buy and don't do anything with them, or I've sold some of them when I just wanted that money to be put somewhere else. I've transferred accounts. I have done so many things with my money, so don't feel like you're stuck by making a decision today. Just cut it with the decision fatigue. Make one decision. If you don't like it, you can change it later. No big deal. If you guys are interested in ETFs, index funds, all of that in more detail, I do have an older how to invest video that I will link in the cards up above. It's older, so don't make fun of me. I wasn't as comfortable in front of a camera, but I did a lot of research for that video, and I think it still has a lot of great information in it, so I will leave it in the cards up above. But let me know if you want some sort of updated version of that video where I dive into a little bit more of the lingo used in the financial space. I also have a brother who is a financial advisor, so I can can ask questions for him. So if you guys have any questions that I can maybe get an answer to, please leave them in the description box down below. And I really appreciate you guys watching this video. Like it if it was helpful. Leave a comment if you have any financial tips that you want to share. And I will see you guys in the next one. Bye guys.